What if I told you that just 7 companies are holding up the entire stock market, and when they fall, they will take your retirement, your savings, and your future with them? Stop and think about that for a second. 7 companies, not hundreds, not thousands, just 7. And right now, these 7 companies, what Wall Street calls the Magnificent Seven, make up over 30% of the S&P 500 total value. Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. Together they are worth more than $13 trillion. That is trillion with a T. Here is what should terrify you. In 1999, right before the dot-com bubble destroyed millions of people's wealth, the top tech stocks looked exactly like this. The same concentration, the same euphoria, the same promise that this time is different. But it was not different. Those stocks crashed 80% and some went to zero. People lost everything. And now, 25 years later, we are watching the exact same movie play out again, except this time it is about AI instead of the internet, and the bubble is even bigger. By the end of this video, you will see why AI stocks are the biggest bubble in history, why the crash will be worse than 2000, and what the banks desperately do not want you to figure out. Because once you understand what is really happening, you will see that the smart money is already heading for the exits, while telling you to keep buying. Leave a like and let us expose this now. Let us start with Nvidia, because this one stock perfectly shows how insane things have become. Nvidia price to earnings ratio is over 70. Now, what does that mean in simple terms? It means investors are paying $70 for every $1 of profit Nvidia makes. The historical average for a healthy company is between 15 and 20. Even during the peak of the dot-com bubble, most tech companies were not this expensive. But Nvidia is, and people keep buying it like it is going to grow forever. The stock is up over 200% in just 1 year, purely on the promise of AI. Not on actual profits matching that growth, just promises. Nvidia market cap is now larger than the entire GDP of most countries. One company selling computer chips is supposedly worth more than the entire economic output of nations, with hundreds of millions of people. Does that make sense to you? But here is where it gets really dangerous. These 7 companies drove 75% of the S&P 500 returns last year. Think about what that means. The other 493 companies barely mattered. Your index fund, your 401k, your retirement account, they all depend on these 7 stocks continuing to go up. It is like building a house where 75% of the weight rests on just 7 pillars. What happens when one cracks? We have never seen concentration risk like this before. Even in 2000, before the dot-com crash, the top 7 tech stocks were only 35% of the market. And those stocks fell 80% on average. Some, like Pets.com and Webvan, went completely to zero. Others, like Cisco, fell 90% and still have not recovered their peak price from 24 years ago. Now we have even more concentration, even higher valuations, and everyone is acting like it is perfectly normal. The worst part is how index funds make this problem worse. Every time someone puts money into an S&P 500 index fund, that money automatically buys more of these 7 overvalued stocks. It is a feedback loop. The more people invest in index funds, the more these 7 stocks go up, regardless of their actual business performance. And when they fall, every single index fund falls with them. There is no escape. Now let me tell you the truth about AI that nobody on Wall Street wants to admit. The revenue does not match the hype. Not even close. Microsoft spent $13 billion investing in OpenAI. You know how much they are making from AI annually? About $3 billion. They spent 13 to make 3. That math does not work. Google AI costs more to run than it generates in revenue. They are literally losing money every time someone uses their AI. Meta is spending $40 billion on AI infrastructure, but Mark Zuckerberg himself admits they have no clear plan for how to make that money back. Here is what is really happening. AI is becoming a commodity. Every company now claims to have AI. It is like in 1999 when every company added .com to their name. Your local pizza shop has AI-powered ordering. Your dentist uses AI scheduling. When everyone has the same technology, it is not special anymore. There is no competitive advantage. And when there is no competitive advantage, there is no pricing power. It becomes a race to the bottom. The adoption numbers tell the real story. ChatGPT user growth is already plateauing. The explosion everyone expected is not happening. 90% of companies trying to implement AI are not seeing return on investment. They are spending millions on technology that is not actually making them more profitable. Enterprise customers are starting to balk at the costs. An AI system that costs $500,000 to implement, but only saves $50,000 in wages, does not make sense. And nobody talks about the hidden costs. Running AI requires massive data centers that consume enormous amounts of electricity. Nvidia top chips cost $30,000 each, and companies need thousands of them. The infrastructure requirements are astronomical. Companies are burning through cash at rates we have not seen since the dot-com bubble. All for technology that has no clear path to profitability. They are betting everything on future potential, not current reality. This is exactly like 1999, except it is actually worse. Back then, everyone said this time is different because the internet was changing everything. And yes, the internet did change everything, eventually. But that did not stop internet stocks from crashing 80%. Amazon fell 94% from its peak. It took over a decade to recover, and Amazon was one of the winners. Most internet companies simply disappeared. Today we are hearing the same phrase. This time is different because AI will change everything, and maybe it will, eventually. But that does not mean current valuations make sense. That does not mean paying 70 times earnings is rational. That does not mean these stocks cannot crash 90%. What makes today worse than 1999 is the structure of the market. Passive investing through index funds barely existed in 2000. Today, trillions of dollars are in passive funds that must buy these 7 stocks regardless of price. Leverage is higher. Derivatives are more complex. The entire global financial system is more interconnected. When this bubble pops, the contagion will spread faster and hit harder than anything we saw in 2000. The triggers are already building. Tesla latest earnings disappointed, and the stock dropped 10% in a day. What happens when Nvidia misses earnings expectations? What happens when one major AI company admits it cannot monetize its technology? What happens when regulators crack down on AI, which the EU is already starting to do? Any one of these could start the avalanche. And here is what banks do not want you to understand. They need you to be the buyer at the top. Every analyst on TV screaming buy AI stocks has a conflict of interest. Their banks make money from trading fees, from IPOs, from mergers. They make money whether stocks go up or down, but they need someone to sell to, and that someone is you. Look at what the smart money is doing, not what they are saying. Insider selling at tech companies is at record highs. Executives are dumping their own stock while telling you to buy. Venture capitalists are quietly exiting AI investments. Warren Buffett is sitting on $200 billion in cash. He is not buying AI stocks, he is waiting. He knows what is coming. Meanwhile, among my retail investors are piling in at the top. Your 401k is automatically buying these overvalued stocks every month. Robinhood traders are betting their life savings on Nvidia calls. Social media influencers, who are literally paid to pump stocks, are telling millions of followers that AI stocks only go up. It is a perfectly orchestrated transfer of wealth from the uninformed to the informed. Here is how the collapse will happen. It starts with disappointment. One major AI company admits it cannot make money. Maybe it is a startup that runs out of cash. Maybe it is Nvidia guiding lower on earnings. The selling begins slowly at first, but then index funds face redemptions. When people want their money out of index funds, those funds must sell stocks. And what do they own the most of? The Magnificent Seven. The cascade effect is brutal. Forced selling leads to lower prices. Lower prices trigger margin calls. Margin calls force more selling. The algorithms that buy on the way up sell even faster on the way down. Credit markets freeze because tech stock collateral becomes worthless. Companies that borrowed against their inflated stock prices suddenly cannot pay their debts. My prediction of a 90% crash is not hyperbole. After the dot-com bubble, Cisco fell 90%. Sun Microsystems fell 98%. JDS Uniphase fell 99%. These were the AI equivalents of their time, the must-own stocks everyone said would dominate the future. Some went to zero. Others, like Intel, are still down 60% from their peaks 24 years later. Even Amazon, the biggest winner, took over a decade to recover from its 94% crash. So what do you do now? First, reduce your tech allocation immediately. If these 7 stocks are more than 20% of your portfolio, you are at extreme risk. Consider inverse ETFs that go up when tech stocks go down. Build a cash position like Buffett. Look at real assets that hold value in crashes like gold, commodities, and value stocks with actual earnings. The opportunity here is generational. After a 90% crash, those with capital will be able to buy world-changing companies for pennies on the dollar. But only if you preserve your capital now. Only if you resist the urge to chase the bubble higher. Only if you see what is really happening. The timeline is accelerating. Earnings disappointments are mounting. The Fed cannot save overvaluation with rate cuts. When money is free but companies still cannot make profits, that is the end. I believe this crash happens within 18 months, possibly sooner, if a major catalyst emerges. The market today is hanging by 7 overvalued threads. The banks need you to be the bag holder while they distribute their shares to you at the top. You can either see this clearly and protect yourself, or become another victim of Wall Street's greatest pump and dump scheme. The insiders are already selling. The question is not if this bubble pops, but whether you will be ready when it does. Comment below, are you preparing for this crash or riding the bubble? Subscribe for more truths Wall Street does not want exposed. And remember, I'm not a financial advisor. This is for educational purposes only. The decisions you make are yours alone, but now at least you know what they do not want you to know.